So you're retired now and you've been saving your money for 30, 40 years into tax-deferred accounts. And you're charitably inclined. And you heard about this thing called a QCD, a Qualified Charitable Distribution, and you want to know how it works. Well, you're in the right place. My name is Robert Martin. I'm a chartered financial consultant, and I'm a partner at Zenith Retirement Planning. So let's get into it. A QCD, a Qualified Charitable Distribution, lets you give money to a charity directly from your IRA in the attempt to avoid tax. But how does it actually work? Well, there's several requirements. Two of them, first one is you must be at least 70 and a half. And the second is the most you can give from your IRA is $100,000. You know, when you're 73 now, as of 2023, you're going to be forced to take money out of your tax-deferred accounts, your 401ks, your 403bs, your IRAs, because the government doesn't want you to keep deferring the tax you owe them forever. So they're going to give you a mandate. You must take money out of your account. Well, you either need the money, and it's great, or you don't need the money, but you're going to have to pay tax on it anyway. And so if that's you, you might consider a QCD, a Qualified Charitable Distribution, where you can take that RMD, that minimum distribution, and give a piece of it or all of it away to a charity. Let's dive into the specifics. So, there's two ways that you usually file your taxes. There's the first way, and there's a second way, and they are very different. The first way is taking the standard deduction. Okay. The government gives you an allowance that you can use to deduct away from your taxable income. For example, if you're single, that number is $12,950 that you're able to deduct away from your income and not pay tax on. If you're a married couple filing jointly, then it's $25,900 you can deduct. If you're 65 or older, you get an additional $1,500 extra per person. So total, you're looking at about $28,900. That's the allowance the government gives you. But you have another option. You don't have to take that allowance. You can actually choose to itemize. And when you itemize, what you're saying is, I don't want your allowance. So you start at zero. But I want to be able to count up my expenses during a year and deduct those. Things like mortgage interest, state and local taxes paid, medical expenses that are above 7.5% of your adjusted gross income. Things like that. And sometimes if you add them up, they end up being more than the standard deduction. So you would actually choose to itemize instead. But here's the thing. When you donate to a charity, if you take the standard deduction, the most that you can deduct is $600. $300 per person if you're married. So $600. That's it. Everything else you donate, you can't deduct. But if you itemize and you give anything above $600, you can deduct all of it. But usually for it to be productive tax-wise, the amount you donate would want to be larger than your standard deduction. The amount you donate plus your qualified expenses that you can't add up must be greater than your standard deduction. So in this case, in order for it to be lucrative, you'd have to give an additional $28,900 to a charity at least in order for the value to be the same from both sides. So with that said, there's a way around it because of the QCD. So, we're done talking about itemized deductions now. When you take the standard deduction, you get your $28,900 if you're 65 and older and you're married. You get $600 if you gave $600 to a charity. Anything else you give, you can't deduct. But let's say you're 73 and you're forced to take this required minimum distribution. Well, you can decide to take a piece of that or all of it, up to $100,000, and give it away to a charity and still claim the standard deduction. So you could give an additional $20,000 to a charity from your RMD and still get the allowance for your standard deduction and your charitable deduction. So if this was you, you'd end up with, well, if I quickly do the math here, which may not be the best because I'm not the best at doing this kind of math, you're looking at $49,500 of deduction that you can take away from your taxable income. Now, if you liked the video, please give me a thumbs up. If you didn't like the video, put a thumbs down. Regardless, I'm happy that you're here and look forward to seeing you on the next video. Make sure you subscribe so you know when we're releasing that new content.